Hi, Gary Kevin here from the Great White North, and we've got our annual update for you end of the year. It was this time last year that the fiscal cliff was being handled and sequestration was taking place. We thought we might have a bad year, but as it turned out, we had 2%
Time flies
growth.
when you're having fun, right?
Yeah, no kidding. We also have a new Fed chairman in Janet Yellen, and if you recall last fall, her and Bernanke and company basically said we're going to taper this bond buying back $10 billion in January, another $10 billion here in February, and hopefully through the end of the year unless something unexpected happens. Housing's been recovering, and you know the stories going on there. Inflation is benign. The Fed's not concerned about it. It's about 1.2 to 2% in that range, but it's okay. Unemployment is now at 6.7%, and job growth at about 182,000 jobs per month. That takes care of all the new hires coming on, as well as taking down some of the folks out there looking for jobs, although there's only a 62% participation rate, which is the lowest since 1978, so that needs to get worked out. The deficit, the government's been running a pretty high deficit. It was $1.3 trillion in 2009. It's down to $642 billion heading south. Personal debt servicing. We were at a high of 14% of disposable income was going to pay for debt, and it's now down to 10%. So the consumers are in really much better shape when it comes to taking care of their debt payments and so forth. But I'd like to switch gears now. We had this great year last year, 32% growth in the S&P. January ended up about minus 3.5% for the S&P. Mm-hmm. So I'd like Kevin kind of address what's going on there.
Well, I think through early February, the market's down maybe 5%, and that largely has to do with kind of that second warning shot or third warning shot that the Fed's put out there in terms of tapering. We've known this is going to happen. We've all been asking for it because printing money forever is inflationary. The decline that occurred in the markets and primarily in bonds in May of 2013, when there was the first hint that tapering was going to start, the money has to go somewhere. And largely the money has been going, a lot of it has been going to emerging economies that have current account deficits. Well, it's logical that they would decline. Does that mean the world's coming to an end? It kind of traces you back to the 2008 fears where, gold has rallied over the last month, long-term treasuries have rallied, that flight to safety. Market was up 32% last year. Well, largely the stock market over the time behaves kind of in a forecasting type measure where they're looking for continued recovery. Well, this recovery has been stalled. You mentioned participation rates, wage growth, that hasn't happened. CapEx, that hasn't happened. It's been largely a profitability growth or share buyback. So, we would be kind of in that neutral territory. Is it overvalued? Not necessarily, unless you've got pessimistic that you really feel that these are peak earnings and that it's going to decline. If you feel that the rubber band can continue to compound and snap it where you can get the second stage of recoveries, you would say that it's fairly valued. So, it's not an all or nothing proposition at this point in time, and especially take into account that this decline over the last month with the second, third stages of tapering. Earnings over the last fourth quarters, over 73% of them, of the S&P 500 companies reporting, have beaten estimates. So, that's not a really negative indication of forward profitability.
Yeah, that's great. Switching back to the long term, I want to take a look at this chart that's coming up on global demographics. Now, you'll notice that for every man, woman, and child in the United States, we're productive at a level of about 52 to 53,000 per year. Our neighbors to the north are number 2 in the world, over 51,000. And if you look at the rest of the developed countries, they're around 40,000 each. So what it says is long term, and this has been going on, by the way, for the last generation, is this country grows, is much more productive than the rest of the world, even the developed world. If you take a look now at this article and the link that we have here, it's an editorial from December of 2013 on the 8 reasons why the U.S. is going to do very well going into the future. The gentleman talks about energy independence here in North America coming up. It looks at reasonable immigration reform. It look at corporate taxes being reduced because we're the most onerous in the world. And there's several other items, so you can take a look at that. But I now want to switch back to a question you might be asking yourself is, what do I do now with my portfolio now that I've seen this little bit of a correction taking place? Is there something I should be doing, Kevin?
Well, if you've been allocated correctly, you're staying the course. Interest rates going up going forward is a positive. That means more income. That's going to help the consumer. That's going to help the overall economy. Largely you've hopefully have it built into your mix in terms of your short-term, intermediate, and long-term. The challenge for us has been over the last 5, 6, 7 years is getting people to stay with what has been traditionally a very good approach of buying when other people are selling and selling when other people are buying. It's hard to do that when you feel that the entire system is going to melt down. I don't know if we've got screaming value here, but there are selected areas, if there are continued declines, where we selectively add to certain areas. Right. Going into this, we've been kind of lightening up for specific client situations into this strength during the course of the past year. Right. So largely, as you kind of let it play out, try to see opportunity where you can add selectively if, in fact, the market gives you those opportunities.
That's great. So we'd like to sign off now and hope you have a great next quarter, and we're going to come back from a place that's hopefully a lot warmer than it is right now. See you next time.